Good evening, friends. A very warm welcome to all of you all, and welcome to our quarterly webinar. Uh, uh, this is a very interesting time for all of us. Last quarter has been an extremely challenging quarter, as they say that there are a lot of times where nothing happens in a decade, and last few weeks where a decade worth of action happens in a week's time, and I think that is what last few weeks has been all about. But the good thing is the quarter is behind us, and I'm happy to share my perspective in terms of how we are thinking about things that have shaped over the last quarter, and more importantly, how we are thinking about economy, markets, and the world going forward from here on. And at the end of it, I'm happy to take questions from all of you all. So, without wasting a time, let me just quickly jump on to the discussion. What we witnessed, friends, was clearly an energy shock for the world, because the probably all of us know the consequences of what America did in terms of unleashing an attack on Iran, and as we know, 65% of the world economy or world GDP comes from countries which are energy importers. If you look at the energy map of the world, countries which are energy surplus or oil surplus constitute just about 7 to 8%, 7.5% of the world GDP. US sits somewhere in the middle at about 25% of the world GDP, and US is self-sufficient in oil. They are a marginal exporter, so they sit right in the middle. And on the right hand side of the curve is 65% of the world GDP, which is energy importer. So when fuel prices or oil prices go up by 50% in a matter of few weeks, it is nothing but an oil shock for the whole world. And this is what it was. The world has experienced energy shocks in the past as well. All of us know, right from the Iranian revolution in 79, or even before that, the Kippur War in 73, 74. But the oil price or the range of oil prices those days were much lower, yet it had a cascading impact on global economy even at that point of time. Extended period of elevated or high oil prices have the ability to push global economy into a global recession. And this has happened in the past because energy is a very significant part of cost for any country and any ecosystem. And if energy prices rise very sharply in a short period of time and stay at elevated levels over an extended period of time, they can push the global economy into recession. That risk always remains. As I said, this has happened few times in the past. But good thing has been that if you look at the duration of energy crisis that has happened in this century, in the last 25 years, in the 21st century, generally the durations have been much shorter as compared to what we witnessed in 70s and 80s. The last 25 years, some of these conflicts, which if effectively translated into some sort of embargoes or constraint on oil supplies, generally have not extended beyond few months, 2 or 3 months or 4 months at max. We've had the Iraq war, the Libyan civil war. Oil price had risen very sharply when Russia attacked Ukraine in 2022, and probably this is one such event which has happened. But it looks like from all of it and from the daily tweets that we get to read from American president, that probably the worst point of this crisis is clearly behind us. And I think it became very apparent to the whole world and all of us that while they did pound Iran, but at the same time, what it really exposed was the limits or constraints which even US has to sustain any conflict for a long period of time. US has multiple constraints apart from the fact that one, elevated oil prices hurts global economy. US at 25% of the world GDP is the biggest stakeholder in the global economy. So they cannot do anything which hurts global economy, because that comes back and hurts America the most. So they can live through a short period of elevated oil prices because they are not energy importers, but an extended period of high oil price will certainly hurt them. Beyond that, America has its own financial constraints given their fiscal and debt levels, and more importantly, in some manner, this did expose some hollowness in Americans' defense system also, when you can neutralize a missile which costs $4 to $5 million to construct with a $15,000 drone, which can be made with $15,000. The cost economics of war are completely lopsided. So it exposed a lot of things, and I think it's a very significant event in that context. While probably all of us are looking forward to a ceasefire in the next few weeks, and but I think from a medium term and a longer term perspective, both for global economies and more importantly for geopolitics, I think it's a very defining event which it will reset a lot of things over the medium term to long term. So in that sense, yes, it's a very significant event. The good thing is that probably the worst point is behind us. Probably we should look forward to a ceasefire. All of us are looking forward to that in the next week, 10 days. And probably as all of us are looking at it, the most important thing is to open Hormuz, the choke point through which we have 20% of the world oil navigates through that. So it's important to open that choke point so that oil can travel and can be transported. I think that's the most important thing, and I believe that once we have a ceasefire in place, probably in 4 to 6 weeks, Hormuz should be completely opened and probably traffic should return back to what used to be. But having said that, as I said, this war has changed. Even while it's just been 5 weeks of strikes by America and Israel on Iran, it has changed a lot of things, at least in the medium term, and geopolitically and from a history point of view, many more things from a longer term perspective. Coming back to what all of this means for India, as all of us know, it's a perfect economic or external shock, macroeconomic shock for India, because as all of us know, India imports 90% of India's energy. Yeah, so India has always been vulnerable to oil prices because energy is the biggest risk as an economy or as a country that we carry at all points of time. While our oil sourcing from Middle East has reduced in the last 4 years because we've been buying more of Russian oil in the last 4 years, but still Middle East constitutes almost 70%, 60% of India's oil, and more importantly, almost 80% of India's gas comes from Middle East. So while the dependence on oil is reduced in the last 4 years, and we now have about almost close to 50% of India's oil coming from Middle East, but as far as gas is concerned, as I said, 75% of gas comes from Middle East. And the challenge here is now that even if first it's very important that Hormuz should be opened so that supplies can be resumed, but we don't know exactly. There is a meaningful damage which has been done to supply infrastructure. We don't know exactly how much that damage is at this point of time. There are a lot of news reports out there, but we don't have an authentic estimate in terms of how much damage has been done, and which effectively means that even when the world normalizes, some part of oil and gas production has been lost for a reasonable period of time, and it will take some time for some of these productions to come back. Meaning, some of the estimates says that the biggest gas facility in Qatar gas facility, which has been hit by drones, multiple drone strikes, probably it will take about 12 to 18 months for them to restore that whole facility, or probably slightly longer. And it calls for investments of about $10 billion to get that facility back on track, which is a very significant investment. Sum total, we expect that oil price, even if the crisis comes to a close, and which it should, and Hormuz is open, oil price post will settle at a level which will be somewhat higher than where they were in February. So probably we are baking in about $85 of average oil price for FY27. What it means for India is, if you see India's oil import bill, which was about $125 billion last year, probably will go up by almost by $40 to $45 billion to $170 billion. So oil import bill, which was about 2.8% of India's GDP, goes to 3.4%, and that's a very significant number in that context. Incremental $45-50 billion is almost closer to 1% of India's GDP. So that's the price we'll have to pay. India will have to pay, and probably looks like, if you ask me, my view is that probably $80-85 looks like to be a new normal for oil prices. I don't see oil price now going back to the 60s where they were before the war. I don't think so, because I think it will take a fair bit of time for all the supplies which have been impacted to come back. And to that extent, it does impact the world and India as well, because we import significant part of our energy requirements. Rising oil prices coupled with currency adjustments leads to a perfect macroeconomic shock for India. India has had these kind of shocks in the past as well. The last time we experienced a shock like this was in 2013, when there was an event called taper tantrum where US Fed had expressed its intent to stop the QE quantitative expansion program that they were carrying on the balance sheet, and as a consequence there was a significant sell-off or runoff or withdrawal of money from all emerging markets including India. If you go back in history and see that during that period Indian currency depreciated very sharply by almost about 20%. Oil prices had risen by about $15 that point of time. India was already running a very high current account deficit of 4.8%, and that hurt India very badly in terms of currency depreciation. Our inflation was pretty high at 10%. We were running a fiscal deficit of 4.9%. Our real growth was about 6%. And our forex reserve was about $300 billion. And as a consequence, bond yields went up in India by about 100 basis points at that point of time in 2013. And equity market had corrected by almost by 12%. The good thing is India's macroeconomic fundamentals pre the crisis, at the starting point of this crisis today, are much more stronger and much more resilient than what they were in 2013. Which effectively means as a country our ability to deal with this crisis is much better and we are much stronger. Having said that, I don't want to undermine the fact that it is a macroeconomic shock and it's a crisis for India, and there's a price to be paid for that, even if, as I said, at the cost of repeating myself, that there's a price to be paid for this, despite the fact that we might get a ceasefire, hormones might open in 4 to 6 weeks. There's a price to be paid, which the damage which has been done to global economy, global geopolitics, resetting of relationship, I don't think so it can be undone now, and that's, I think, the short-sightedness in terms of what has happened. We have seen something similar this time around as well. Currencies depreciated by about 4% in the month of March itself because of this escalation in oil prices, which went up by almost 60%. I know oil prices are now under $100, but let's see where they settle post the crisis. Once we get the peace deal and flows coming in, that needs to be watched out. But even a $30 higher oil price is a meaningful impact for India. At $95 oil, it's a significant impact for India. As a consequence, we think India's current account deficit, which was about under 1% for the last few years, will shoot to 2% this year, this financial year FY27. It's logical to expect that there will be some fiscal expansion. The government cannot keep up with its budgeted numbers. So there will be some slippage on fiscal deficit, because eventually I believe the impact of higher oil prices will have to be absorbed by all the three constituents of the economy. The government will have to absorb some part of it. Some part of it will have to be borne by corporates, and which effectively means, at one hand, when it comes to oil prices, probably oil companies will be bearing some burden of it. And because of oil, prices of all the other commodities and raw materials have gone up. So companies will take price hike to pass on those to the customers. But I think still they will have to absorb some part of it, and which can impact corporate margins or profitability. And I think because oil, we should expect a increase in fuel prices, probably some part of it will have to be borne by the consumer as well. So I think all the three constituents of the ecosystem will have to bear this. Sum total, we should still expect logically that there will be some slippage on government's fiscal deficit targets, because there's a price to be paid. The good thing is the starting point of inflation was very benign inflation, so we can absorb this inflationary shock of oil prices and rising commodity prices, and still inflation should be in a manageable range, I would say. And as a consequence, while we were expecting another rate cut from RBI during the course of this year, probably in the first half of this year, I think that's clearly now out of the window. Our estimate is that probably rates remain, the short-term rates or the repo rates, which RBI decides, remains flat for the rest of the year. So the rate cuts are out of the window, and probably RBI remains on a pause mode for the rest of this financial year. So obviously rate cuts are not there. We also see about 50 to 60 basis points impact of this event on India's growth. So we see growth slipping to 6.5% from where we were at 7.5%. The good thing is our forex reserves are much higher at the starting point of this crisis at $700 billion. So we can weather this storm, as I highlighted. Bond markets have already reflected that. Bond markets, yields in bond markets have gone up by about 40 basis points in the month of March. And stock markets were down by about 12% in the month of March. But the one important point I want you to, all of you to carry from this is generally it's been my experience and data shows that whenever India is a reasonably large economy, I'm sure all of us understand this. India does not face this kind of macroeconomic shocks very often. But yeah, oil prices or withdrawal of easy money does lead to that impact. Like in 2013, it's a gap. It's after a gap of almost 13 years that India is witnessing a macroeconomic shock. When we experience these kind of shocks, stock markets, financial markets, be it stock market, currency markets, bond markets, they tend to obviously respond very fiercely or vigorously to in terms of falling. But experience tells us that the medium term growth outlook for Indian economy continues to remain strong, and long term India is a great growth story. Every crisis gets resolved at some point of time, and as a consequence, while markets fall sharply during when the economy goes through, when India experiences a macroeconomic shock like this, in the subsequent 12 to 18 months leads to a significantly higher returns in equity markets. This is what happened after August 13, where in the next 12 months between August 13 and September 14, equity markets were up by 45%. I'm not saying that markets will go up by 45% from here on, but the point I'm trying to say is it leads to much higher returns in equities over the next 12 to 18 months as the crisis recedes and as the economy reverts back to its normal growth curve. So, which is why I say, every crisis is an opportunity, and I see one such great opportunity to be investing into Indian equities into this crisis. And the good thing about India is, while the external world remains challenged, India can deal with this crisis probably much better than a lot of other economies in the world, because as you can see from here, 60% of India's economy is driven by domestic demand. PFCE, as we call it, private final consumption expenditure, constitutes 61% of India's economy, and government expenditure is about another 12-13%. So 75% of the Indian economy is driven by government expenditure and domestic consumption. Very few economies in the world have such a large and robust domestic economy. There are just about 5 economies amongst the major economies in the world which have such a large domestic economy, and India is to be fortunate to be one of those. So, as I said, while crisis has an impact, it reduces India's growth rate. We have from our internal estimates, our estimates are that India's growth this year, FY27, will be down to 6.5% from where we were at about 7.5% last year. So there's almost 100 basis points drawdown in India's negative rub-off effect of this crisis on India's growth. But as I said, while markets respond to this in the short term, but that point of time is also a great time to make investment into equity markets, because the economy will get back to its growth 7%, 7.5% growth trajectory in 12 months from now, and markets will price that much earlier. So generally when India faces, I'm just reiterating this again, that generally when India faces a macroeconomic shock like this, those are great times to be investing into Indian equities, because the returns in the subsequent 12 months or 18 months are significantly higher. And the good thing is that the peak point or the worst point of crisis is behind us. Probably incrementally things should be much better as things evolve from here. So in that context, probably this is what I was trying to highlight, that if you look at the historical trends, every time we have faced a crisis, investments made during periods of such crisis have led to much higher returns for investors, because markets have recovered very sharply or bounced back very sharply in the next 6 to 12 months post the crisis, because the underlying fundamentals of India as an economy and as a country remains fairly strong and resilient. And once you pass through the crisis, over the next 12 to 18 months, it's a normal tendency for Indian economy to bounce back to its normal growth curve. And when markets fall in panic or in middle of this crisis, they tend to overreact to this crisis. While trying to factor in that crisis, when we are buying stocks, or markets are pricing the value of a business over a long period of time, over the next 15, 20, 30, 40 years of that life cycle of the business. When the stocks fall very sharply, or equity markets fall very sharply in response to a crisis, we need to understand that while it might impact the value of that business or the performance of that company for the next 12 or 18 months, the long-term fundamentals of that business over the next 10 or 20 years remain unchanged. Right? So which is where it creates a distortion, or what I call a value gap, between the price which is reflected in the stock market and the underlying value of the business, which is much higher than that. And that value is a great opportunity for value investors to step in and buy those stocks. I can clearly say with confidence that with this correction, I clearly see that value and that opportunity, or that window of opportunity, having opened up in Indian equity markets. Because now after this crisis, in the last 3 months, in the Jan-March quarter, I've seen a lot of stocks fall anywhere between 20 to 50%, and some maybe even more. And as a consequence, I see a lot of companies where long-term value or long-term fundamentals are significantly better. From a longer-term perspective, when I value those businesses, I find stocks at extremely attractive price. As I said, if you look at the history of each of these past crises, right from global financial crisis of 2008, we had a European debt crisis in 2011, there was a Chinese currency readjustments in 2015, we had an ILFS crisis in 2018 where ILFS as a financial institution went bust and they defaulted on their bonds, and that created some sort of a liquidity and solvency crisis in India's financial markets. COVID pandemic, each of these crises after crisis, we've seen that or a Russia-Ukraine war, each of these events, when they happened, markets responded very sharply, and they fell anywhere between 15 to 20, 30, 40%. But over the next 1 year, because the long-term fundamentals of Indian economy are resilient and strong, they've bounced back very sharply. And which is why I say that every crisis is an opportunity, and don't waste a crisis, don't let go a crisis go waste, because long-term fundamentals for Indian economy continue to remain very strong and very resilient. So that's the big point I wanted to make. And longer term, as I said, if you look at the history of Nifty returns over the last, across time horizons, over the last 5, 10, 20 years, Nifty has delivered returns between 13-14% CAGR. So the long-term compounding, Nifty is a great compounder at 14% in INR terms, at about 10% in dollar terms, does place Nifty as the best performing equity market in the world. Probably now, I would say last 2 years, US markets have done very well. So probably now the second best markets in the world after US, but that's still very significant. So I think that long-term returns of Nifty are, as I said again, are driven by the underlying strong fundamentals for the Indian economy. And in that context, this is a great opportunity to be investing into Indian equities. Also, maybe for benefit of everyone, I can just highlight this. If you look across the performance, annual calendar year performance of Indian equity markets, these markets have given positive returns every year on a calendar year basis in the last 10 years. We've had multiple crises in the last 10 years, including the COVID crisis, the Russia-Ukraine war. On a full year basis, last 10 years, these markets have given positive returns every year. And if we overlook the modest negative return of 4% in 2015, then they've actually given positive returns in 13 out of the last 15 years, which effectively means anyone investing into Indian equities with a 1 year time horizon, your probability of making money is extremely high. Probably I would say is as good as 100%. I think this is a reflection of the strong and stable macroeconomic fundamentals of Indian economy, and which is what I'm trying to highlight again and again, that remains very much in place. While there is a price to be paid for this crisis, we can deal with it, we can absorb that shock. It will that will have an impact on our P&L at the government level in terms of fiscal deficit, at the corporate level, or at the consumer level in terms of consumer spend and wallet over the next 6 or 9 months or 12 months. But beyond that, things, because income levels will rise, government income will rise because of taxes, corporate profits will rise because of demand, we can deal with it and we'll move on with it. So, which is what I'm saying. Having said that, maybe just to set in context, maybe this crisis came at a time where we were in a very nascent stage of a cyclical recovery in the Indian economy. All of us know last year CY25 was a slow year for growth in Indian economy. We had very strong growth for last 4 years out of COVID between 21 to 24. Corporate profits, Nifty 50 profits grew at about 18% CAGR in the last 4 years. CY25 profit growth was just about 4%. And we were looking at double-digit 10% profit growth this year in CY26. It is possible that profit recovery or growth recovery in corporate profits might get pushed back by couple of quarters, and which effectively means the recovery in corporate profit, because corporates will get impacted because of rising raw material prices, and they might not, because in a lot of commodities raw material price hikes are very significant, compounded by rising oil prices and also by the currency adjustments or the depreciation of the INR versus dollar. They might not have enough pricing power to pass on all of that cost increase to the consumer, because then they might not want to hurt demand, and to that extent they will have to absorb some of it, and which will push back the recovery in corporate profits. But I still in the second half of the year, but I think so the recovery in corporate profits can get delayed by a couple of quarters. I think that could be the case. But again, having said that, what I want to really highlight is, again, from my past experience, I've seen that whenever India gets a 2 or 3 year period where corporate profits grow at a moderate rate of single digit, after that, once we get growth back, we tend to see a very sharp rise in corporate profits. So I think I would not hesitate to say that while recovering corporate profits might get pushed back by a couple of quarters, I certainly see that CY27 will be a very strong year in terms of recovery in corporate profits, as I envisage, because we will be coming out of almost 2.5 years of consolidation in corporate profits. So I see a very strong profit rebound in the rebound in corporate profits in CY27, and as I said, markets will discount it much earlier. So I think, which is where the optimism on equities is. And the good thing, meaning every crisis has some good thing. The good thing about this crisis from an equity market point of view is that markets have corrected very sharply at about 18 times 1 year forward earnings. Now Indian markets are trading at the level they were the cheapest that we have seen in the last 5 years in this bull market. So all through the bull market, markets have been pretty expensive or pretty richly valued, but this has opened a window of opportunity where you can buy into one can buy into equities at valuations which are probably much more reasonable and somewhat lower than the long-term averages, and certainly the cheapest point or the lowest point in this bull market in the post-COVID. So I think that's where the opportunity is. A lot of people have asked me in terms of where are those opportunities. So just to give you a broader sense, meaning, for example, we've seen, last year we've seen a very strong, we've seen a very healthy recovery, I would say, in credit growth. Credit growth for FY26 was about 15% in the banking system, and we see that growth sustaining going forward in this year and from here on as well. And we've seen whenever you get a macroeconomic shock to any economy, the first casualty is financial sector, because financial sector is at the heart of the economy. Anything goes wrong with the economy, it does have an impact on the financial sector, and as a consequence, the first thing stock markets do, or the first reaction we see in stock markets, is a sell-off in financial related stock, and which is what has exactly happened in India, where banking stocks have fallen very sharply in the month of March. Some of the banking stock, including HDFC Bank, now are trading at valuations which are closer to where they were in 2008 global financial crisis. So likewise, valuations have become very attractive in that context. So likewise, there are a lot of stocks and sectors where valuations have become extremely attractive, and I think that has opened a window of opportunity for us to be investing into these stocks, or probably buying these stocks at valuations which are at a discount to long-term fundamentals of where they should be. So if I were to summarize this, meaning once again, I still believe that India is on a path, is in the midst of a growth super cycle. We still expect that India will, over the next 7 to 8 years, will do a 7.5% real growth, which effectively means India transitions from a $4 trillion economy to $8 trillion economy by 2033. And if that can be done, then I think it's very reasonable to assume that Indian equities can comfortably compound at about 13 to 14% CAGR at the Nifty index level over the next 7 to 8 years, which effectively means Nifty doubles over the next 6-7 years, kind of thing. So I think despite the shock and the crisis, the story very much remains in place. Probably the growth recovery gets pushed back by, as I said, few quarters, but otherwise the story very much remains in place. Maybe with that, maybe a quick update in terms of how portfolios are positioned, and then I'm happy to take questions. So in terms of our portfolios, we continue to remain a significant exposure to financials. Financials is our largest exposure, where we own some of the large banks of India, and followed by consumers. We have been constructive on consumer as a sector. While it has got impacted, meaning some of the stocks have fallen, but I still think consumers have been fairly resilient in this sell-off. And I think as things normalize, we see a meaningful recovery in consumers. We also use this sell-off as an opportunity to buy into some of those stocks which have fallen significantly. And we've added stocks like, within autos to our portfolios. We've added names like Maruti to our portfolio, which has fallen very sharply. And we see a strong demand. The demand recovery which happened in auto sector post the GST cuts continues to sustain the momentum, and we see very healthy growth in auto as a sector going forward, despite the shock. Likewise, we've seen, for us, crises like these are opportunities to buy into some of the great businesses at a much more attractive prices. We've always liked the food delivery and e-commerce space, so we've bought into Eternal, for example, and we've been adding into some of the other names as well. Some of the sectors that we like post this crisis we like energy as a sector. I think energy becomes very important from here on. India's energy, obviously this crisis has once again exposed India's energy insecurity or vulnerability in that sense, and I think there will be significant emphasis in terms of very massive investments in the energy sector in India, probably to address these issues, and as a consequence, energy as a sector is something which we've started liking, and probably we are making investments into that sector, or adding that sector, increasing our weightages to that sector in the portfolio. So as I said, portfolios remain fairly resilient. We feel pretty good about. I know we've been coming out of a period of consolidation in equity markets, where the last 18 months have been challenging. Markets have not gone anywhere. Money has not been made. But I think some point of time in the next 12 to 18 months, markets will, as I said, longer term Nifty has still done 14% CAGR, which effectively means that if we have not made returns in the last 18 months or so, some point of time I see a much higher returns in the next 12, 18 months, which will make up for that time value of returns which we have lost in the last 18 months. So I certainly expect a very strong cycle for equities in the next 12 to 18 months in that context, driven by, as I said, strong underlying economy in India, and more importantly, a very resilient or healthy profit growth in corporate sector, probably at a later stage in this cycle. For our portfolios also, last 1 year has been somewhat challenging. I must concede that, because we were somewhat concerned about the economy and the global macroeconomic outlook post the tariff war which President Trump had unleashed last year. We've been cautious all through the last year on the economy, and as a consequence, we've had a more defensive stance in our portfolio. And as a consequence, our portfolios have, we've not had such a great year last 1 year. But before that, I'm sure all of you will acknowledge that we've had a very strong returns in 5 years prior to that, between 2020 and 25. Last year was also a year of consolidation for us from a portfolio perspective, but I certainly see a very healthy returns for us going forward from here on, and we should get back to, now our view on the economy has changed, where we're feeling much more constructive about the economy and the markets from here on, and as a consequence, we've made appropriate changes to our portfolio. And as a consequence, I'm looking forward to a much better year in terms of equity outlook for markets and for our portfolios, and revert back to our trajectory of delivering healthy returns, which we have experienced for 5 years, 7 years before that. So last year was also a period of consolidation, because we had a slightly more conservative stance on our portfolios because of our clouded outlook on the economy and cautious outlook on the economy and corporate profits. But now that all of that is behind and markets are down, stock prices are down, that clearly means, one, our outlook on the economy is much better, and valuations are much more attractive, and which allows us to take much more constructive and maybe a somewhat more aggressive stance on a portfolio, which all of you will see as we go forward from here on, in terms of what we're doing with our portfolios. So with that, maybe I'm already on, I think, 45 minutes on the call. So I'll take a pause here, and I'm happy to, I can see a lot of questions there. So I want to try and cover most of them. So I'll try and answer answer those questions, friends. Just to share with you all, last thing, our India Next strategy on the PMS side has been awarded amongst the top 3 strategies now consistently for the last 3 years on risk adjusted returns. So while returns, I always say that while returns are very important in equity markets, what's equally important is to understand the risk you're taking to generate those returns, because markets every few years will go through a cycle where external events will happen, shocks will happen, like the one we witnessed now. uh, a high risk portfolio will have a much higher drawdown during times of those crises and shocks. So it's very important uh, uh, to have measured risk or moderate risk, which what I call in the portfolios, and yet deliver healthy returns or high returns, and which is what we always focus on, delivering superior risk adjusted returns, and which is what we've been able to deliver consistently over the last so many years. And these awards are a testament to that in terms of what we've been able to deliver for our investors at large. Yeah, with that, maybe I can quickly move on to questions. Uh, Give me a moment while the question comes up. Uh, The first question is, in this current volatile environment, what makes large caps particularly attractive at this point of time in the cycle? Good question. What has really happened is, uh, what we've seen is when you have an external shock like this in the economy, a macro shock eventually translates or transitions to micro. It goes down to corporates. What really matters in periods like this is the ability of companies to adjust to that shock or to the pressures that they deal with. And obviously, I'm sure many of us know, and experience tells us that large cap companies are have a much far higher ability to deal or absorb these kind of shocks versus mid cap and small cap companies, because they are far more resilient in terms of their business modes, their balance sheet strength, and the strength and capabilities of their business. So their ability to weather these kind of volatile or challenging period in the economy is much better than that of mid and small cap companies. And also, what has happened because of the correction in the market, now a lot of large cap stocks have fallen very sharply, so which effectively means that these companies are available at much better valuation, and which effectively, and probably given the fact that the next 1 or 2 quarters can remain challenging from a real economy point of view, I think these companies will be able to navigate that much better. And experience also tells us that large companies, because they're very competent and capable, they use these kind of crises to expand their businesses, probably squeeze out more market share from mid cap and small cap companies who could have working capital issues or funding issues, or who have leverage on the balance sheet, and as a result they cannot they tend to cede market share. So we think large caps probably over the next 12 months will are much better placed to deal with this and than mid and small cap. Having said that, there's been a very sharp correction in mid and small cap also. So on a selective basis, probably mid and small caps will also do well. The next question is, what are the global factors such as war and geopolitics impacting our portfolio positioning? So I think, friends, I think the most important thing is that probably now a new realization, probably a reinforced realization that probably uncertainty is the new normal in the world. We all of us know how the new how American president has behaved in the last 12-15 months, and when you're making decisions and announcing decisions on social media, and meaning obviously a lot of these decisions are not even thought through. Well thought through, and there are a lot of unintended consequences of these kind of decisions, which obviously US has to face, but more importantly the world has to face. So I think it's very important for us that what we're doing is to understand the resilience of business model of each of our companies, and their ability to deal with uncertainties, deal with situations which might arise, which no one is aware of also. So how prepared, how competent, how well positioned these companies are, and at the same time avoid companies which are not, which are fragile business models, and more importantly avoid companies which have significant leverage on the balance sheets. So obviously all of these things does go into our thinking and in terms of our stock selection and portfolio positioning, because that's become very important. The next question is, what is the current stance on some of those sectors including BFSI, consumption, and IT. So friends, we continue to remain positive on financials as a sector. As I said, financial stocks have fallen very sharply in the last month because of rising oil prices, rising bond yields, and currency depreciation which has happened. But we still think that India's macroeconomic fundamentals are fairly resilient. We don't see a significant resurgence or rise in NPAs in the banking sector. So we think the growth in the sector remains fairly strong and valuations are very reasonable. So we like financial sector and we continue to stay invested in the sector. Having said that, obviously, while that's at the top end level, but I think eventually it's a game of your ability to, on a bottom up basis, pick right companies, because not every company will outgrow the industry. So obviously, we are invested into companies which we think can navigate this kind of environment and deliver much higher growth. And probably are companies which are led by some of the best management teams that exist in this country and in this industry. We've had a fair exposure to IT as a sector. IT as a sector has been at the receiving end of the market in the last few months because of fear of AI. We think a lot of these fears are all of these fears are completely unfounded. We think the sell-off is more narrative driven. There's a fear that AI can meaning make the business model redundant for IT companies. We think that's completely flawed. In fact, AI will be a great enabler for these companies to deliver much higher growth over the medium term, over the next 3 to 5 years. And we don't see these companies getting, their business model getting impacted. In fact, all these IT companies are themselves adapting AI within their own business, by virtue of which they are becoming more efficient. And in fact, they are acting as a strategic partner to their clients to implement AI in clients' business. Meaning, for example, recently, 2 weeks back, TCS, the leading IT company in India, reported their results, and they declared that now TCS does about $30 odd billion of revenues, and out of which 8% of their revenues on an annual run rate basis, about $2.3 billion comes from AI-driven projects that they're doing for clients. And they counted various examples of various clients who are counting upon them as a strategic partner for implementation and adoption of AI. So Indian IT companies have a great story, great opportunity to help clients adopt and implement AI. And we think AI will be an enabler for IT companies, and in that context, we like IT as well. Consumption in India has been sluggish for almost last 2 years. We had started seeing early signs of recovery in consumption in rural India, and gradually we are seeing that spilling over to urban India as well. So we think India is in the midst of a cyclical recovery in consumption, and in that context, we like consumer as a sector and companies within that sector. So that answers all the questions. The next question is, where are you seeing the strongest earnings visibility and growth opportunities over the next 12 to 24 months? So we see strong growth in once again banks, but apart from that, we see very healthy earnings growth coming to autos as a sector as well, because the underlying demand in autos continues to remain very strong. And we see that demand momentum sustaining, because for a period of 3 years between 22 and 25, auto growth was sluggish, and after a gap of 3 years, we've seen post the GST cut, demand coming back to auto as a sector. So we see very healthy, strong earnings growth in auto as a sector. Apart from that, we see healthy growth in, as I said, in consumers as well, and probably some of the commodity companies also, because commodity prices have been fairly resilient. So I think that's another sector where probably earnings growth or profit growth will remain fairly strong and resilient over the next few years. The next question is, what are your views on rising crude oil prices? As I said, we need to understand that whenever the commodity prices rises, we need to understand that whether it's driven by demand pull, whether demand is far exceeded supply, or it's because of supply disruption. So in this case, all of us clearly know that the rise in oil price is more due to supply dislocation and disruption, and not because of strong demand. So as I said, my view is that because some part of the supply infrastructure and supply has been lost, at least for a reasonable period of time, at least for the next 12 months or so, if not more, I think crude prices will remain somewhat elevated or higher than where they were pre the war. And our assumption from whatever we have read so far and we have assessed is probably there is a loss of about 2.5, 3 million barrels of oil supplies. Some part of that can be made up by some other OPEC members, but there can be still be a gap of about 1.5 million barrels in oil supplies, which effectively means oil prices can remain elevated. And our estimate is probably an average oil price of $85 for FY27 before they revert back to something like $70 in middle of CY27, which is where we expect oil price to settle down. The next question is, what changes have you made in the portfolio over the last 6 months? So, well, we have not made much changes, I would say, friends, in the last 6 months, but in the last few months, we have certainly made changes in the portfolio. As I said, after this correction in stock markets and after this event, our view on the economy has turned somewhat more constructive in terms of growth outlook, and secondly, valuations have become more attractive in the sector and in the markets versus where they were 3 months back or 6 months back. So, as a consequence, obviously we are, and as I said, our portfolio stance was somewhat defensive for the last 12 months. So, now probably we want to give up those defensive stance and position a portfolio for growth, because we have a better handle and visibility on growth going forward over the next 12 to 18 months, both in the economy and corporate earnings. And as I said, valuations are far more comforting now than what they were at 12 months back. You'll appreciate that the markets have been flat over the last 12 months, right? And we've had earnings growth or corporate profit growth in the last 12 months. So valuations have become attractive. So now that makes us more comfortable to take that risk and go out and invest where we can find a lot of ideas on a bottom-up basis where healthy returns can be made over the next 12 to 18 months or 24 months. So yes, you will see all of that happening. As I said, we are adding energy exposure to our portfolio because we think energy will become a big theme and a big play from a growth perspective over the next probably next 5-10 years in India, because we certainly need to take as a country decisive steps to start addressing our energy insecurity. This is not something which can be achieved in the next 5 or 10 years. It probably will take 20-30 years, but at least we see that consciousness on part of the government and policymakers, and we see significant investments flowing in the sector. So that's another one sector which we have added exposure to our portfolio in the last few months. The next question is from Saurabh. His question is, your views on IT, please, as the portfolio still has IT exposure. What is the growth outlook here, and do the present prices reasonable? Whether the present prices are reasonable to capture future growth? Is the EPS growth still compelling here? So, Saurabh, yes, our view on IT remains constructive. As I said, we see, as we envisage, IT as a sector is coming out of 3 years of slow growth. We think the growth this year, FY27, for all the leading IT companies of India will be better than the growth last year in FY26. And obviously, because stocks have fallen, valuations have become much more attractive in that sense, and we see a very favorable risk reward in the sector. We think, and we certainly think that probably growth will accelerate for the sector as more and more diffusion of AI happens in the world. IT services players will become strategic partners for corporates in adoption and implementation of AI, and that will become a big driver of growth. So while growth, we see growth accelerating, early signs of visibility of growth acceleration probably in the middle of the year, which effectively will translate into a much better growth next year on a FY28 basis for IT as a sector. So we think our view on IT as a sector remains fairly constructive, I would say. And valuations certainly are very attractive in the sector. They are significantly below the long-term averages where the sector has traded in the last 25 years. In fact, they are at one of the lowest point of valuation that one has seen in the last 25 years in the sector. So the sector valuation are at the bottom of the cycle, and growth trajectory for the sector is improving, which effectively means some point of time we'll see an uptick in valuation as well. The next question is from Vivek Tanna. Are we in a sideways cycle or a growth cycle? Well, Vivek, the economy has been in a growth cycle undoubtedly. There will be some moderation in growth, as I said, in the economy this year because of the impact of this. But as I said, stock markets were in a consolidation cycle, or what you call sideways cycle, what you've been calling for the last 12 or 18 months. But my view is that probably now that we'll have strong earnings growth because there's a lot of latent demand that exists in the economy, and that demand will play out over the next 12 to 18 months. So I see we getting back to a strong profit growth cycle probably in the second half of this year and spilling over into next year. So I see markets which have been in a consolidation mode in the last 18 months probably will come out of that consolidation mode, and I see markets delivering healthy returns in the next 18 to 24 months. The next question is from Chanchal Gupta. Do you think 10-year large cap valuation discount would move away in this financial year? Good question. Chanchal, I definitely see that happening because there was a slowdown there was a moderation in growth, and there was pressure on profit margins. Corporate profit growth for large cap companies was somewhat muted, and we can see that Nifty 50 profit growth was just about 4% last year. As I said, I expect very healthy profit recovery for Nifty companies or the large cap companies. That profit recovery I was expecting this year, but I think, as I said, just reiterating that once again, that profit recovery gets pushed back by 1 or 2 quarters. But I certainly see that happening, and I CY27 I see strong profit recovery for Nifty companies and the large cap companies, and I think that should help bridge that gap in large caps valuation versus their long term averages. The next question is from Umesh. What your strategy for risk management to safeguard capital? Umesh, you will agree, see, we are a long only investor and we generally do not take cash calls on our portfolio because we have only a part of clients' money. We believe clients are doing their asset allocation at their own level in terms of debt and equity. What we tend to do is, when we tend to get somewhat cautious on markets, we tend to move into defensive stocks. So those stocks tend to probably stay resilient in a falling market, or tend to probably fall much less, and which is what we've been doing in the last 12 months because our view was somewhat cautious in the economy. But now we are, as I said, we are gearing our portfolios to be pro growth, pro cyclical, and pro growth and pro acceleration. So we're making that shift, but you'll appreciate that it's difficult for us clients, when they give money to us, they give money to invest and not sit on cash. As a true long only manager, we believe asset allocation is done by the client, and as a consequence, we don't take cash calls. In fact, our clients don't like us taking cash calls because they say that they will decide the market trend and do the asset allocation. They don't want us to be taking that call on their behalf. What they want is to stay invested with their money, deploy the money in equity and stay invested, and which is what we do all the time. So I hope I have answered your question. The next question is from CA Sharad. How long government will be able to absorb the pain of rising crude and depreciating rupee? Good question. Not for very long. I don't think so the government can absorb it for a long period of time. Currently, I think the government, we are in the midst of an election cycle. As all of us know, there are elections in 4 states. So government is not talking much about it, and probably they're waiting for the whole situation to stabilize. Once they want to see the ceasefire happen, they want to see the Hormuz open, and then they want to assess what's the new oil price and what the real impact is. But I don't think so the government has significant ability to absorb this. So all of us should be prepared for a rise in fuel prices as consumers, both gasoline and diesel prices will go up some point of time in the next few months. I don't think so the government can absorb it for long. They don't have the wherewithal to do that. The next question is from Geeta. What should be the ideal way to enter into equity today? As well, what should be the tactical cash that should be kept in hand? Anyone looking to invest into equities, what I can tell you, Ms. Geeta, is that this is a good time to invest into equities. Okay, because I think the peak of this crisis or war is behind us, and markets are still down, and this is a good time to invest because during the course of the year, I think the outlook for the economy will keep improving, and I think markets will respond to that. What is the cash one should keep? See, it's a difficult call to make because I think it's depends on person to person, on their risk appetite. So it's a very subjective question, and meaning I think you should consult a financial advisor, or probably someone from our team can engage with you and probably understand your risk framework and then give you appropriate advice in terms of what will be a good cash for you. The next question is from Satvik. Will the FIs come back considering the rupee fall? Good question. Uh, See, the currency has really hurt foreign investors. In fact, with the sharp currency adjustment that we've had last year, almost 9%, now almost 5-year returns from Indian equity markets are down to single digit. So, in dollar terms, because of the sharp adjustment that has happened. But I still think that, now all of that is in the base. India underlying growth is fairly resilient. And I think some point of time, foreign investors will definitely come back to India. There is no doubt in my mind about that. What has really happened is in the last 18 months, one of the big drivers of global growth has been AI driven investments, and countries which have direct AI companies, whether the foundational model companies or AI hardware companies, the semiconductor companies, are seeing a very, very strong growth. So which we've seen very strong returns in equity markets in countries like Korea and Taiwan, which have a very strong AI story. China has very strong AI story, so companies there have done pretty well. And as a consequence, global investors have taken money out of India, which does not have, AI investments or AI companies, and gone into some of those markets. I think some point of time, these whole AI companies will also peak out, and when investors start looking at longer term growth stories, then clearly money will come back to India, because probably every other market, my firm belief is every other emerging market is cyclical. India probably is one of the only and few secular growth story within emerging markets. So I definitely think investors will come back, and my view is that probably that will happen towards the later part of this calendar year, and CY27 will be the point when foreign investors will come back to India. The next question is from Chetan. Last 2 year returns are nil. How much returns we expect in 3 years from today? As I said, Chetan, good question. As I said, returns in equity markets are not linear. Equity markets go through cycles. Unlike fixed income, where returns are linear, equity markets are cyclical in that sense. But over a medium term and long term, Indian equity markets have done about 14% CAGR returns. The very fact that we have not had returns in equity markets in the last 2 years effectively means that some point of time in the next 2 to 3 years, I think returns will be much more stronger to compensate for the time value of lost returns in the last 18 months or so. So I certainly see very strong returns for equities in the next 2 years. And I still think that on a 5-year cycle, India will do a 14% CAGR return. So now you can work around the numbers that if on a 5-year cycle, if you have to do 14% kind of a CAGR returns, if there are no returns in the last 24 months, then effectively what kind of returns we need to compensate for that in the next 3 years. And I think those returns are reasonable expectations. The next question is from Avinash. There is a narrative that global investing looks more lucrative relative to India considering the PE and business available there. Is that really the case, or it is just a narrative? Countries like US, others are having stocks like Mang. Okay. I think referring to Fang as a bucket or basket. You're right, Avinash, that one, US as an economy and US markets have done very well because of the evolution of AI and AI driven stocks and the FANG story in US, and some of the regional markets have done very well in the last 18 months. The only thing I want to highlight is while these kind of things can happen in a period of 1 or 2 years, on a 5-year, 10-year cycle, one, India as an investment destination continues to remain equally attractive. There's nothing that makes India less attractive from an investing point of view. So that remains very much in place. For a longer term investor, if you really ask me, I think the two secular growth destination outside of India would be one US, because it's a very large economy. More importantly, it's a very dynamic economy, and although innovation, I know, I'm sure all of us understand, it's the bedrock of innovation. All the innovation happens there first, and that innovation creates huge amount of value, and which is what you're referring to, FANG companies, in terms of whatever they're doing at the cutting edge, the frontier of technology developments, trying to bring the future to present, and in the process creating huge value for stakeholders. And obviously the other market which now looks like a secular growth story is Japan. Japan is coming out of almost 35 years of deflation, and Japan is now a growth economy. And given the fact that they're coming out of a deflation cycle which lasted for more than 3.5 decades, I think Japan is a growth story for the next decade. And markets there, valuations there are still very attractive, because you can still buy some of the largest Japanese companies at 10, 11, 12 P. And these companies, because inflation is back very strongly in Japan, Japan is growing and will continue to grow. For the last 20, 30 years, there was very lackluster and low single digit profit growth in Japanese corporate profits. But I think that is set to change. Probably Japanese profit growth will get back to high single digits and probably low double digits at some point of time. So I think Japan is a market looks attractive. So I think, if you ask my advice, I think one should still have a large part of investments in India, but it's not a bad idea to have some exposure to global equities and into some of these markets. Yeah, I think I've covered most of the questions. There were quite a few. There's some more left, but we're already 10 minutes past the hour. We are at 10 past 5. What we'll do is, if there are some unanswered questions, probably our team will reply to you in person on those questions. And with that, maybe I could call this call for a close. Friends, thank you very much for your taking your time out, for joining us this evening, and for your patient listening. As always, I enjoy this conversation with you all, because it gives me an opportunity to share my perspective on outlook for the world and for markets, and also at the same time update you on what we are doing with the portfolio and how we are thinking about it. So for me, I really thoroughly enjoy this. I'm sure you had a great time. With that, thank you very much for your time. Thank you.